Welcome back, everyone. Today we're diving deep into the latest 13F filings to uncover what the smart money, big investors like Warren Buffett, Bill Ackman, Michael Burry, and others have been buying and selling in the second quarter. These filings give us a rare glimpse behind the scenes to see where these investing titans are placing their bets. Instead of just focusing on the top 5 most bought stocks, we're switching it up a bit. In this video, we'll highlight the 5 biggest stories to come out of these filings. From surprising new investments to major sell-offs, this is what the pros are doing with their money. Starting at number 5, let's talk about Bill Ackman's big bet on Nike. Ackman, who runs Pershing Square Capital, has made some legendary investments in the past. Remember his $2.6 billion windfall from credit protection during the 2020 market crash? Well, now he's eyeing Nike, despite the brand taking quite a hit recently. Nike's recent earnings report wasn't pretty. They slashed their full-year guidance and predicted a 10% drop in sales for the upcoming quarter, with concerns over weakening demand in China and unpredictable global consumer trends. On top of that, their pivot towards a direct-to-consumer model has met with criticism from shareholders. Despite this, Ackman bought over 3 million Nike shares, worth about $230 million, right after the stock took a 20% dive. It's a bold move, especially since it represents just 2.2% of his portfolio, but it shows confidence in Nike's long-term strategy. Will Ackman's bet pay off? Time will tell, but it's one to watch closely in future filings. Next up at number 4, we've got an unusual play from Mohnish Pabrai and Guy Spier, investing in coal. Now, coal might seem like an odd choice in an era focused on clean energy, but there's more to the story here. Pabrai already had substantial holdings in coal miners like Consul Energy, Warrior Met Coal, and Alpha Metallurgical Resources. And now his close friend Guy Spier is also dipping his toes into the same companies. So why coal? Well, not all coal is created equal. These investors are focusing on metallurgical coal, which is used for steel production, not energy generation. And while the world is moving away from thermal coal for power, met coal is still essential for making steel. What's interesting is that despite being essential, these stocks are trading at rock-bottom valuations. For example, Warrior Met Coal has a price-to-earnings ratio of 7.4, while Alpha Metallurgical is around 5. This deep value play, combined with solid dividends and share buybacks, suggests Pabrai and Spier see potential upside in a sector that most investors are avoiding. Now let's move to number 3. Michael Burry, the legendary investor of The Big Short, is doubling down on Chinese tech stocks. While Burry is known for trading in and out of stocks frequently, his positions in Alibaba, JD.com, and Baidu have remained consistent since late 2022. Burry actually trimmed 30% of his position in JD.com, but added 24% to Alibaba and a whopping 87% to Baidu. So why is Burry holding on to these positions? Despite China's economic challenges and a massive sell-off in Chinese stocks, Alibaba is down 73% from its peak. Burry sees deep value. For instance, Alibaba's free cash flow gives it a price-to-free cash flow ratio of around 8, making it a bargain in Burry's eyes. He's betting on a long-term recovery, despite China's current macroeconomic woes. At number 2, we have a surprising move from Seth Klarman, selling down his position in Google. Klarman has been a long-time holder of Google, but in this quarter, he reduced his stake by 63%. This takes Google from the second-largest position in his portfolio down to the 6th. While this could be part of a broader portfolio rebalancing, it's more likely that Klarman is taking profits from a stock that's been swept up in the speculative frenzy around the Magnificent Seven. Google, despite being a fantastic business, had surged over 100% from its 2023 lows by the end of the second quarter. It's not just Klarman either. Bill Ackman also trimmed his Google holdings. This doesn't indicate that there's something wrong with the company, but rather that these investors are locking in gains at a time when tech valuations have skyrocketed. And finally, the biggest story from the 13F filings. Warren Buffett selling Apple. Berkshire Hathaway reduced its Apple stake by 49% in Q2, taking the position from 50% of the Berkshire portfolio down to 30%. Now, before we get too alarmed, let's keep this in perspective. Buffett didn't sell out completely. He's still holding 400 million Apple shares, and that's no coincidence. It seems like Buffett is happy to take some profits at a low tax rate while keeping a significant long-term position in Apple. With Apple's price-to-earnings ratio now at 34, up from the 12 PE when Buffett first bought in, this move looks like a classic example of taking advantage of a good run while still betting on Apple's future. Buffett isn't getting out entirely. He's just being cautious with Apple's near-term growth potential. And that wraps up the 5 biggest takeaways from the Q213F filings. From Bill Ackman's bold bet on Nike to Warren Buffett's strategic Apple sell-off, there's a lot to unpack this quarter. Let me know in the comments if you like this new format focusing on the biggest stories, or if you'd prefer a return to top buys and sells. In the latest 13F filings, several significant moves were made by major investors, shedding light on their strategies during Q2. Bill Ackman made headlines by investing in Nike, purchasing over 3 million shares after the stock dropped 20% following a disappointing earnings report. Despite the short-term challenges Nike is facing, such as lower sales guidance and uneven global consumer trends, Ackman is likely betting on the company's long-term potential as it shifts towards a direct-to-consumer model. Looking ahead, the moves made by prominent investors in the latest 13F filings offer valuable insights into the potential future trends in the market and the broader economy. Each of these moves hints at larger themes and emerging opportunities that could shape investment strategies in the coming years. Starting with Bill Ackman's bet on Nike, we see a classic example of contrarian investing. Despite Nike's short-term struggles, such as a drop in sales and concerns over its business in China, Ackman's move indicates confidence in the brand's long-term potential. Nike is in the process of shifting from a traditional wholesale model to a direct-to-consumer DTC approach. This pivot could position Nike for higher margins and greater control over its brand, allowing it to directly engage with customers. If this transition is successful, Nike could set the standard for other retail giants to follow. As the retail landscape continues to evolve, with more companies focusing on e-commerce and personalized customer experiences, we may see a trend where other large brands follow Nike's lead in cutting out middlemen and focusing on DTC strategies. The challenge for companies like Nike in the future will be navigating global economic uncertainty, particularly in key markets like China, where consumer demand is fluctuating. However, if companies can weather these storms and capitalize on the growing importance of e-commerce and direct engagement with customers, they stand to benefit from stronger brand loyalty and improved profitability over the long term. This trend could lead to increased competition among global brands to refine their customer experience and build more personalized, data-driven marketing strategies. Meanwhile, the investment decisions of Mohnish Pabrai and Guy Spier to focus on metallurgical coal point to another key theme: the continued reliance on traditional industries, despite the global push for clean energy. Metallurgical coal, unlike thermal coal, is essential for steel production, and it's unlikely that the world will transition away from steel in the near future. Steel remains a critical material for infrastructure projects, construction, manufacturing, and various industries. As countries invest in rebuilding and expanding their infrastructure, particularly in emerging markets, demand for steel will likely remain strong, which in turn sustains demand for metallurgical coal. What's interesting about this trend is that it represents a broader theme of old economy sectors continuing to play a vital role in the global economy, even as newer, more tech-driven industries take the spotlight. While many investors have flocked to renewable energy, technology, and other high-growth sectors, there's a case to be made for the enduring importance of industries like mining, energy, and manufacturing. As such, value investors like Pabrai and Spier are finding opportunities in these sectors, where stock prices have been driven down due to market pessimism, but where strong cash flow, dividends, and buybacks offer steady returns. This could lead to a renaissance for traditional industries, particularly those tied to infrastructure and industrial production, as countries like the US and China focus on modernizing their infrastructure in the coming years. Shifting focus to Michael Burry's continued investment in Chinese tech stocks, we see a speculative but potentially lucrative play. China's economy is currently facing significant headwinds, driven by issues in its real estate sector, regulatory pressures, and slowing consumer spending. This has caused many investors to flee Chinese markets, leading to a sharp drop in the stock prices of major tech giants like Alibaba, JD.com, and Baidu. However, Burry's decision to double down on these companies suggests that he sees value in their long-term potential. China's crown jewel companies, as Burry refers to them, remain integral to the country's economic infrastructure. Alibaba, JD.com, and Baidu are not just e-commerce and tech giants. They play critical roles in China's digital economy, cloud computing, and artificial intelligence, AI sectors. If China can stabilize its macroeconomic situation, these companies are well positioned to benefit from a recovery in consumer spending and business investment. Furthermore, as China continues to invest in technology and innovation, these firms could be leaders in emerging sectors such as AI, automation, and advanced cloud services. The trend here points to a long-term recovery for Chinese tech, albeit with significant risks in the short term. Investors willing to weather the volatility and uncertainty in China could see substantial returns if the country's economy rebounds and its tech giants regain their footing. However, geopolitical risks, such as tensions between the US and China, will also play a major role in shaping the future of Chinese tech companies. As the world becomes more digitally interconnected, Chinese firms could either flourish in an integrated global economy or face headwinds from political and trade disputes. Next, Seth Klarman's reduction in Google shares reflects a broader theme of cautiousness surrounding the tech sector, particularly the Magnificent Seven stocks, which include tech giants like Apple, Microsoft, and Nvidia. While Google remains a strong business, its valuation has surged, driven by speculative enthusiasm for AI and other emerging technologies. As Google and other tech giants become overvalued, more investors are starting to take profits, signaling a shift away from the tech-heavy portfolios that have dominated in recent years. This move suggests that while AI and tech innovation will continue to be major growth drivers, the valuation of these companies may need to reset before long-term investors re-enter the space with confidence. The current speculative mania surrounding AI is reminiscent of other tech bubbles in the past, where expectations outpace the actual development of the technology. As companies continue to develop AI solutions, investors will likely focus on those that can demonstrate tangible improvements in efficiency, profitability, and real-world applications, rather than just speculative promises. The future trend for AI-related companies will likely be one of differentiation. Companies that successfully integrate AI into their operations and develop innovative, practical applications will thrive, while those that fail to deliver on the hype may see their valuations correct. The focus may shift toward companies that can show clear, measurable benefits from AI adoption, such as improved supply chain management, customer engagement, and automation of complex processes. Finally, Warren Buffett's decision to sell part of his Apple stake highlights another key trend: profit-taking and capital preservation amid market volatility. Apple, which has been a cornerstone of Berkshire Hathaway's portfolio, has enjoyed a massive run-up in recent years, with its price-to-earnings ratio climbing to 34 from the 12 PE ratio Buffett initially bought in at. While Buffett still holds 400 million shares, his decision to reduce the position suggests a pragmatic approach to taking profits while maintaining a long-term commitment to Apple's future growth. This move reflects a broader theme among large investors: the importance of balancing short-term market movements with long-term growth potential. In a high valuation environment, even the best companies can become overvalued, prompting investors to lock in gains while still maintaining exposure to the companies they believe in for the long run. Apple's continued innovation in areas like AI, hardware, and services suggests that it will remain a dominant player in the tech sector, but investors are becoming more cautious as valuations rise. If you enjoyed this, don't forget to like, comment, and subscribe. Your support means the world, and it helps us keep bringing you more great content. Plus, I'd love to hear your thoughts. Drop a comment below.